Hello guys, glad to have you on board again. Today we're going to review some intraday scenarios today, and I'm going to change just a bit the organization of those shows, just because I want to make them a little bit quicker than the usual average, which is almost an hour long. We'll stick to long videos on Mondays because we take care of swing scenarios. There's a shit tons of assets to cover, so Monday's shows will definitely be as long as usual. But on Tuesday and Thursdays, for the intraday purposes, I want to make them a little bit shorter. So the way we're going to be achieving this is just we're going to stop covering the swing updates on those shows. So I'm not even talking about the swing updates right now. I'm going to cover them inside Discord because I think this is much better. It leaves a track, you can follow through, it's really great. So all the swing trades are going to be handled and followed through inside Discord's swing alerts, pure and simply. So we're going to really stick to intraday in here, and we're just going to pick a single asset, and we're just going to take care of intraday analysis of this asset all over again, each and every time we're going to do intraday analysis. So I'm going to stop picking stuff, random stuff. I'm just going to do intraday analysis to highlight areas in which we can trade. So this is what we're going to do on Tuesdays. So we're going to do two different types of intraday because intraday strategy can be there are multiple ways to intraday trades. There is this one, you trade just one asset, always the same one, and every day, every single day, you repeat the same routine. You try to identify which reversal areas, high probability reversal areas are nearby, and which you're going to start trading and look out for signals in them. And the second option is the one we were doing at the moment back then, is taking multiple assets, taking a basket of assets, and trying to identify which one has the clearest context to trade. Like remember what we were doing with the matrix and stuff like that, like kind of going for intraday charts, all right? You basically have a set of assets, like 8 assets, and you're just going to start randomly picking, not randomly, oh sorry, you're going to start picking the one that shows up the best opportunities, the clearest context to profit from, all right? So this is what we're going to do on Thursdays. And on Tuesdays, every Tuesdays, we're just going to take care of the SPX. All right. So I'm of course always going to make a quick intro about cryptos because I know there's lots of you guys who care just about them. So they are moving quite interestingly at the moment. So we're taking care of cryptos in just a 2 to 3 minute intro on those shows, and then we move on to SPX only for simply showing you how to highlight interesting price area on these assets. So first of all, Bitcoin, there's a new information I wanted to share. I just discovered it yesterday. Remember, this is one of the stuff I was using back in the days. That doesn't mean it is an absolutely major information. It's just at some point it is interesting to have a look at those things. Remember, these are the volume demand momentums. So these are RSIs of both the bearish and bullish demand in the order books. So what really stunned me is that it just confirmed what I thought. So this is not, the information all by itself just is pretty much worthless unless it goes along a context. And I think that's the context I was trying to highlight, and this information just gave me the confirmation I was seeking for. It is exactly this. We're not really rising because of strong bullish momentum. We're most likely rising because we have no more sellers. And it really makes a lot of sense because you've got this technical analysis in here you can really understand. Just show this, focus on the red line, okay? The green line I don't even give a shit about, all right? Definitely the bulls are in here, but as you can see, this isn't the strongest bullish demand momentum we've had in time because we've gone significantly higher in bullish demand back in the days, and we're not at the summit, all right? But we've been at the summit of selling demand in here, which means guys like me who saw this area asked out partially. Once again, these guys just asked for partial profit taken, no more than that. So as you can see, bearish demand, we've been going sideways for a bit, and then bam, the bearish demand just basically surged, like way more people getting to sell The guys who were thinking about a false breakout, the stupid guys once again. You don't sell a market that rise for good reason. It was expectable for this market to rise from ashes. What wasn't expectable is for bears to go stupidly against that. So that wasn't a reason. I think this is where the smart money has been partially profit-taking. But in here, some speculators were there to say, oh my God, it's going to crash once again. Let's sell that shit. What have they been doing? Selling without a single reason to do it. So too much sellers, no more buyers, extreme decorrelation, and bullish stupid breakout. But we didn't broke up because of strong bullish demand. We broke up because there was too much bears. That's simple as that. Way too much bears, and then what's been happening? The bulls are gathering interest. So, as we rise, the bulls are gathering interest. That's as stupid as ever because that's the stupid FOMO trade. All right, we haven't been accumulating bulls. We've been just getting some stupid late-stage traders jumping in the boat as we're probably already reaching out the end of a destination. So, the thing is, what really concerns me is the fact that right now we've gone from extreme top out of selling demand to extreme bottoms. So that's really the thing, all right? I think it is not even about buying right now. I think it's more about how sellers behave in this market. Look at the volumes. Oh, my goodness. Crypto market is back alive. It's the bull run. Look at the goddamn volumes. They're pretty much non-existent. There's nothing like a volume that matters right now. So low volumes, price action made by reversals and wrong footing structures. So we're most likely rising because there were too much bears than rising because the stock market, the crypto market is so strong. So once again, be really, really cautious with that kind of market. These are once again psychological price behaviors. That also explains why we're trading so irrationally in the 1 hour chart time frame with that crazy bubble pricing. All right, that explains a lot. All right, and to me that is the common context. We're rising because we don't know where to stop, because we were having a shit tons of sellers, but the problem is we don't have them anymore. So why the hell would you go higher? There's no need to go higher. We don't have any sellers to stop loss or whatever. So the thing is that right now, no one knows where to go. Simply because we've gone there for stupid reasons, and we might just either unwind this entirely and retrace, or try to go a little bit higher to trap some more bulls, and then wrong foot the bulls after being wrong footing the bears. That's exactly what I think it is. So it's the kind of market you cannot really anticipate. You can only range trade that. And as this was pretty irrational for a bit, it doesn't come without risks. So it is risky to trade this market, can only be done with a range. So once again, I think it's a matter of professionals. If you're a beginner, just stay the fuck away. If you're an intermediate experienced trader, then you can try coming across these markets, but you do it very cautiously, very tiny position sizing. If you take a loss, you take it, you don't fight it, you just let it go, all right? You tried, it didn't work out, simple as that. So I think the best approach is exactly the one we've been setting in motion since a few days, selling in this area, securing the trade, and see how it goes. Either we go break higher, and we're going to try probably breaking this area, which is, I don't very well know. Normally in that kind of stuff, we're going to go cross a resistance, all right? Just to, because it's psychological, I mean, psychologically important to break a significant level to just print emotions, all right? If we want to get bulls in, then we need to break a resistance. And I don't know if this can be considered as being one, or if this is this one that we won't like to break. If that's going to be this one, then probably we could have another couple days of bullishness, or just a upper shadow candle breaking through this level but not holding the close or something like that. I wouldn't necessarily be surprised. This would be just normal to me. So is there still a little bit of upward potential? Yeah, definitely, possibly. Is this something you want to trade? Definitely not. Definitely not. It's way too late to catch up on trying to pick up the crumbles down the floor. It's not how it goes. You can do it, but it's very risky, and I don't think this is the kind of speculative trading I'm trying to teach to you. That doesn't mean it's not going to work. All I'm saying is that if you want low-risk trading opportunities, that doesn't fit my plans. That's it for cryptos. Moving on to the SPX. So we forget about all the rest of the shit. We forget about all the weekly chart scenarios and stuff like that. You focus on short term, which means any fucking thing on top of 1 hour charts is none of your concern. Remember that if you have time, I strongly recommend you have a look at the daily price structures with gaps. So you look at the SPX, not the SPX 500, which is the futures derivative. You have a look at the caching structure, see if there is gaps nearby or areas that may just attract us like magnets. So in the current market context, I would say no. All right. The structure is pretty uninteresting. We've been doing 2 doji days orientated pretty much to the downside, so it is hard to say. We've got no bias for today. Today is going to be randomly priced in. We've got a couple gaps, but they're pretty far away from current prices, so I would say this is not a big deal, at least not something you really need to matter. So there's no gaps that may attract us in the pricing, in the underlying pricing structure. We do have this one though. Oh, I missed it actually. Yeah. Oh, sorry about that. So we've been closing in there and opening there the day right after. So there is a gapping structure in here. You really need to have this one on your charts. All right, this is definitely a gapping structure in there. So it is from 29.13. So I'm going to just put an alert in there just to make sure I don't forget about that. It's a key level, and I just want an alert. So it's SPX 1 day entering gap cash. All right. What the fuck is that? All right, don't give a shit about that. All right, so that's just it. All right, for the pricing, the structures and pricing, we know that we've got a gap in here that we need to care of if we ever go there. Otherwise, it's pretty far from current prices, so we don't give a shit about that. We go intraday, 1 hour, and we do the study, the usual study, the process you will want to repeat through time if you want to trade a single asset on an intraday basis. Whether it's SPX or whatever the fuck you want to trade, it's always going to be the same structure. Daily cash structure if you're having a look at an index, because it matters. If you're looking at anything else, there is no need. I mean, if you're trading forex, you don't give a shit about that. But I don't suggest you should trade intraday forex, or you do euro dollar, but that's all you can do, all right? All the forex cannot be traded intraday. So indices, all right, we're here. What do we do? First thing first, you zoom out until you can figure out some kind of context. So now I think in this broader picture we do have something to work with. We can definitely say this is probably a market top. It's been setting itself, probably a very late stage bullish trend. How do we see this in here? Even if I don't have enough history, we can very well say that this was a long run, and in the late stages we managed to have unfolding support context boxes, suggesting very late stage trending. All right, so late stage trending, multiple, final excess. All right, the market has been trying hard to go higher, failed, and bang, reversal. We've got the first range structure, range reversal, range confirmation, range, and range. So what is the underlying context we're trading right now on the 1 hour chart time frame? A goddamn range. Which side is probably this range, and how mature is this? It's a range, it's a bullish range consolidation. So how much boundaries do we have so far? 1, 2, and possibly 3, or we're going to have to look out for the third one with a lower low than yesterday. So we have a 3 or potential third point in here, and the mature range is 4 boundaries. So remember that if we're looking at a mature range to restore some trending possibilities in this market, we need 1 more boundary. So this range is not mature, so how do we apply the strategy? The usual strategy. Remember that first point only for professional traders, or at least experienced trader. We're going to try catching up the late stage of a bearish movement. All right, we're going to try going against the trend when it's late stage. Second point, rarely going to be traded by beginners, only by intermediate traders. Third point, everyone can trade this one because the only required conditions are to have at least 76% Fibonacci retracement, or 61 if you're intermediate. So this point, everyone can take it, beginners included. So that's the most tradable signal in the range, the one most traders will get on board. And for obviously, I want you guys to get in this one as well. Yesterday we tried. It doesn't really fit all the rules, so I told you to stay the fuck away just for some security purposes. But remember, the plan that we had yesterday was to trade this area. Yesterday the blue area was there, remember, right? Just updated it for the French guys. We're going to get to why I got it there. Yesterday, in here, no tradable signal. Remember, the context boxes were unfolding, so it wasn't possible to take this trade. I told you to wait. We had another signal in here, divergence, blue triangle, sine wave target, everything needed, but I told you to stay away from this signal because sine wave wasn't confirming any fucking thing. The sine wave was in the positive area, saying you rather have liked to wait for further excesses or taking the trade, but with a large stop loss to absorb some potential further on volatility. So yesterday I told you to stay away. I have no regret, and I stand on that. That was the most rational stuff to do. Those who took the trade anyway, and you must be secured at the moment. But we could have woken yourself in here this morning, wouldn't necessarily have been a surprise. And we could very well go there today. That wouldn't even surprise me neither. So the thing is that this is the area we're going to care about today. Remember that we're trading a 1 hour range, all right, in which we're looking at potential Fibonacci retracement. So we put the goddamn fibs, bottom to top, all right. We've been testing 61% fib, so this is the reason why yesterday I didn't want you guys to get to jump on board because it was just 61%, so only experienced traders could take those trades. Beginners, you want to wait for 76% fib, so this is where you want to trade today. With prices going at least in the context or possibly below context, to trade and to fit the strategies, plans, and rules to get at least close to 76% fib. So today, for everyone, beginners, experimented traders, professionals, or stuff like that, this is where you want to trade, close to the 76% Fibonacci and probably a little bit below. All right, we can go down to this previous dip, and this is the area I think is the area of interest for buying entries today. If we don't go there, then you just don't buy. There is still other opportunities. What you need to do on an intraday basis, the goal you need to set for yourself is to have multiple options, multiple plans, multiple scenarios of what is the most likely things to happen in a day. All right? So to me, first option, it's always going to be 3 options. A buy entry, a selling entry, and possibly sometimes a breakout entry. All right? So in here, if we want to buy, we know where to do it. It's only there. There's no other way we can buy. All right? It's getting in there and buying or not doing any fucking thing. All right? In order to sell, I think the selling area is still the same we had highlighted yesterday, which means this is the final boundary, 4th boundary range of the range. This is where selling entries will be interesting to do today, but probably not going to be there today. So rarely or less likely going to be there today because it will be very violent to go there on an intraday basis. So probably just tomorrow with the Fed to go there. So if we go bullish today, there's no way we can sell because it's probably going to be by tomorrow. So selling activity, not really possible today. Buying activity, yes, only if the market managed to make a dipper, a lower dip. All right, so it leaves us with a third option. Is there a possible breakout scenario to put in place in here? Yes, there will be, because when you're ranging, you need to assess just one thing, one additional information. In a range, there's always a breakout area, generally at the mid part of this range, close to the median area, close to 50% fib, and generally you'll have a low volume area to help you confirming this. So you put your range in perspective, right? If you do have the volume profiles in TradingView, that's great. If you don't have them, don't worry. There are multiple ways to figure out where the breakout area is. It's just there are multiple clusters of information that will point you to a single area. Like I said, low volume area definitely is a tip, all right? Normally, you should see where prices are accelerating in the range, and you can definitely see that. To me, this is there, right? This is where the range mid area probably is. So let's put that in broader perspective, right? So let's say this is the mid part of a range. So this is where we can break out trade. So today, can we trade the third option? I think the answer is yes. So today's interesting scenario, possibly a buying entry, speculative buying entry in here on 15-minute signal inside the 15-minute context. Second option will be a breakout of this area. It can be a 15-minute breakout, but in that perspective, you need to follow the breakout plan, which means you need to go context first, pull back into the trend channel, and breaking through context and trend channel in the same time afterwards. All right? So that will be the way you would 15-minute break out this area. But you can also trade 3 minutes on the intraday. So for those of you who are a little bit more aggressive, then I suggest you can put some alerts out of 3-minute short time frames to look at for potential 3 minutes breakout context. And in here, we're way more mature. Just have a look at this, all right? Remember, just open your little book in your head. What is the accumulation context information you're looking out for? If you want an accumulation, you must see one thing. Price getting into context, pull back into the trend channel without getting back to the opposite context and pulling back to context. So in here, there's a possible breakout that may occur in the 3 minutes, and it's also highlighting the area we saw, the 2860 area. So I would say if we go there and if we accelerate through both the context and the trend channel with a breakout, I would say this is definitely something you can trade. In that perspective, you take the breakout entry in there. All right, let's say you break out trading here. Remember that you need to trade when we break up the resistant context. So this is where you're going to take the trade, 28.69.59 and no less. If you take the trade in here thinking, all right, it's great, it's granted, it's open doors, we're going to go there, you're not fitting the plan. If you don't get through the context channel with a close, then there's no breakout. All right, once again, follow the rules. If you bend the rules, then you just lose all the advantage of the statistical advantage I provide. So it will be just like that. Remember that a breakout trade puts its stop loss down the previous lows. So this is where you're going to put the stop, 0.45 stop loss. I say you risk no more than 1% of capital on this kind of asset. So there's a leverage too you can set in here. All right. What you're going to do is that you're first profit taking at a 1-to-1 risk reward ratio. So any fucking way you're going to partial profit taking in here, you're going to do it taking profit 50% and pay for your stop loss. So you get in, you put the stop loss here. In here you pay for this fucking stop loss, which means if prices break up, goes there and sell again, gets to your stop loss, you lose nothing. All right? If price gets there, works this area and continue to the resistant area in the daily scenario, in the 1 hour scenario, then you're fine and you're going to make a nice gain and you can take this gain to pay for your selling entry in here. That's how you can do. You take the breakout trade to sell for free in the interesting swing area. All right? You just manage the risk. We're in a range. It's going to be tricky. So if you do stupid trades, you're probably going to take a loss. If you do it fine, you're probably going to end up with a tiny gain, but better have a tiny low risk gain than multiple risky gains in a range. All right? We identify the context as being a range. It's not the easiest one to catch up on. So be trading, trade rational. You don't try to make yourself a billionaire out of ranges. You're just trying to catch up some easy gains to pay for the most interesting trades, which are the speculative ones. All right, so you wait for today. How do you handle this? Using the tools, because once again, remember the major goal of the tools is to give you some framework to work with to help you understanding how professionals sees markets without having the maturity to see this. All right, you don't see the market the way I do see them, simply because I've got way more experience than most of you guys. But still, what I'm doing with those tools is trying to put you into my mind, trying to show you how I see markets, because I don't really need to have framework to see a range or an accumulation or stuff like that. It is just my mental projection of how can I turn those subjective stuffs into rational, binary stuff that you guys can understand. That's the best way I found. I mean, framework is just the best way to represent the way I see, sorry about that, just touched the microphone, the way I see markets, but in a subjective way. What I see, you guys can't see this simply because you haven't been watching our fucking charts for 8 years. All right? So that's how it goes. Okay? So this is what the indicators does. They translate my language that you cannot understand to things you can rationally understand. And the second stuff is that they help you with semi-automated strategy, which means they allow you to semi-automate the strategy and use alerts so you can stay the fuck away from your charts, avoid overtrading and all those new biases that we very well know about. So how do you do this? You set up alerts. You use your tool's advantage. So how do you do this? You highlighted multiple options today. If we go there, you want to look out for a bullish trade entry. So you put a horizontal alert. We get there, which means we're getting closer to the interesting buying area, so you just put a horizontal alert to this price. Whenever we break down the previous low, you want to be alerted because something will happen that matters. Something else, we go there. We've been highlighting that this area is an area of interest. Put a goddamn alert in here, pure and simply. And finally, those who are aggressive traders and experienced trader will try eventually to get to anticipate the breakout by looking out for accumulation trades. All right, like this one could have been an anticipation trade, but no signal, so no trade. But how do you do this? You put a goddamn alert. You say alert, framework. What do you want? An accumulation. How long do you want this accumulation to last? Until tomorrow. And you just said that. SPX, 3-minute. Trend accumulation, create, and that's done. Period. You move on to something else. You just been highlighting whatever the fuck is the most probable into your intraday scenarios. Either we go there, you're going to search for a bullish trade. We go there, you look out if you missed the accumulation trade and you're going to try see if there is a potential breakout to follow through. If the conditions are met, you take it. If the conditions aren't met, you don't take it. If you want to trade the accumulation, then you're going to wait for this. As there was no signal in here, you need to wait for price to get into context, pull back once again to the trend channel, give you a signal in there, and then you're going to take this trade. This will be the accumulation anticipation, only for experienced trader. Others will just wait for the breakout, all right? It's pure and simple this. It isn't that complicated. You put it some context, you put it some scenarios, so you done what every fucking professional does. You contextualize the market, you build a plan, you wait for a goddamn signal. That's how professional works. If you get in there and say, oh, I think it's going to do this, or I think it's going to do that, then yes, but that's not trading. That's gut trading. That can be trading if you have a lot of experience, because at some points these things starts to get automatized. I see the market, I know what I'm going to do. It doesn't take 15 minutes to get to those conclusions. I do this in just a 2-minute setup in my own practical examples of trading, because I know how to do this. I've been doing this for so long. But still, that's the process I'm doing. First, context. Then I build my plans, my different scenarios, the one I'm ready to trade with the different risk managements. I put the damn alerts, waiting for something reliable to show up. And then when something triggers, I go there, I watch out the information, I review them, and I decide whether or not I take the trade with what kind of risk management, depending on how aggressive the signal is. Let's assume a few options, all right? Let's say we do this. We get to trigger the accumulation alert later today, all right? In here, I got a blue cross close to the trend channel without touching the context. And let's say, okay, momentum is doing something like that and that. And in here, I've got, like, for example, bullish signal, all right? I've got a bull, like a bull signal. It's definitely the kind of stuff I want for an accumulation. Early trending signals in a trend channel, close to a breakout area, that's definitely what I will take, all right? If I go there and I've got, for example, a taking profit structure setting itself, or an overload, like gray signals, what do you think I'm going to be doing? I'm going to probably take the trade as well, but with a much different risk management. I'm probably going to take half the position sizing I would have taken with a bullish trade. I would probably put a stop loss much, much further away, which means I'm not going to put a stop loss in there. I'm probably going to put a stop loss a little bit further away just to make sure I'm not being chased by some lower shadow candle, stuff like that. And I'm going to risk less than 1%. If I take a bullish trade, I'm probably going to take a 1% risk. All right, as simple as that. The better the risk management is, the more you expose your capital to it. The lowest, definitely, the lower amount you put in. It's simple as that. All right, taking profit signals, I'm probably just going to risk 0.5% of my capital in that kind of trade. And I'm going to leave it half possibly open for the breakout. Okay, I'm going to take 50% on the anticipative trade, and I'm going to take the remaining 50% on the breakout itself. All right, that's how you manage the risk. That's the perception of trading. It's never black or white. It's always shaded gray areas, and it all depends on what the market will give you at the moment the trade will trigger. So what kind of trade am I going to take? I goddamn don't know, because I need the market to show me the answer. And for that, I need to wait. How do you wait? You put some fucking alerts and you move on. Because if you stay in front of your charts, you're going to see stuff that is irrelevant and you're going to overtrade. All right? So that being said, we're going to stop in here today. It's half an hour and it's more than what I expected to do. So I hope you learned quite some interesting stuff. Once again, this is the exact same story you need to repeat each and every fucking day if you want to do intraday trades on a single asset. All right? So see you guys on Thursdays for intraday analysis, and Thursdays, like we said, we're going to have a look at a broader basket of assets to figure out what interesting intraday trades we could have on them. Goodbye and wish you a good day. And tomorrow, of course, we see each other again to put on the correction of the second part of the MCQ test that we did last month, as we still have the final 10 questions to answer. So see you guys tomorrow.